Okay, welcome everyone. Let's get started. Great to see you all here. Some familiar names in the group there. Fantastic to connect with you all. I know some of you have been waiting a while for this to start. Some of you signed up nice and early, so that's great. Some of you have just signed up today. Um, it is great to connect with you all. It's going to be a very good month. We've got a lot to learn. Very exciting times ahead. All right, so just before we get started, just a quick disclaimer that everything discussed is for educational purposes only and should not be considered investment advice, financial advice, or a trade recommendation. And no representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Make sure you check out the disclosure document, characteristics and risks of standardized options, available from optionstradingiq.com/risks. All right, so before we get started, just a couple of little housekeeping things. If you want to ask a question today, do it via the chat if you don't mind. And also, if you change it, I think the default is just to all panelists. If you change that to all panelists and attendees, other people will see your questions, and then that way, people will know what I'm talking about when I start answering questions. One other item, hopefully you've all got access to the members page. You should have received an email from me with the details. If you haven't got access to it, here's the link here. I'll pop that in the chat as well, but hopefully you've all got that. This is your reference page for the course. So this is where you can find all the links to the webinars, which you've obviously found already anyway. We've got the link to the Discord chat room. I know a few people have reported having some issues joining, so I've posted a second link there if that one works a bit better. I don't know, for whatever reason this one's not working. Some people have also said that they're having issues with Google Chrome, but fine on other browsers, so give that a try as well. So hopefully you can get in there. If not, just email me with any issues. Download a couple of trading plans here, so a couple of examples. We're going to go through all of these. Some flow charts, beginners section. If you're fairly new to options, check some of that information out. That's good to get a base understanding of what we're going to be talking about over the course of the month. Some videos there for you as well, spreadsheets, position size guide, strategy selection guide, and then underneath is where I'm going to put all the webinar replays and a link to all the case studies. So I'll set up all the case studies for the month via a Google Doc, and I'll provide a link to that here. So again, everything you need is always going to be on this members page, replays, things like that. I'll also email out all the replays, and I'll provide the link to the replay in the chat room as well. So if you're not getting any of that information, just reach out to me, but that should all be coming through. Make sure you've whitelisted my email or added info@optionstradingiq.com to your address book. That way it'll help make sure my emails get through to you. So hopefully that covers everything, but if you've got any issues or concerns, just drop me a line. Yep, Alan, that's a question that comes up. Will sessions be recorded? Yes, everything's recorded. Just double checking, I am recording at the moment, so that's good. And yes, all recordings will be emailed out to you, put in the chat room, and also here on the members page. So you should absolutely have no issues getting all of the replays. And if you can't attend live, or you have to leave early, or you want to go back and watch again and re-go over some of the key concepts, you should have plenty of opportunity to do that. You'll have access to this page forever. I'll never take this down. So you'll just, if for whatever reason you get busy over the next month, you can come back to this anytime and access all the information. All right, so hopefully that covers everything. But as I said, if you've got any questions or issues, just let me know. So plan for today, I'm going to talk about how to find trade ideas. So I'm going to show you a few of the tools that I use and some of the methods that I go through to find good ideas. In terms of technical analysis, I tend to be a bit more of a technical trader than a fundamental trader, and I really like to keep things fairly simple. I don't believe in having loads of different indicators and things like that on your screen. I have a couple of key things that I look at. One of them is moving averages, and the second one is money flow. So I'll talk about how to monitor that, how to set up your screens, your charts, and I'll show you the sort of things that I look for. Today, we're going to focus on mostly directional credit spreads, which is kind of a really foundational concept. So once you get the hang of credit spreads, you can then move into iron condors. And then from there, you can start, once you've got your head around those, you can start doing some more advanced stuff like calendars, butterflies, and diagonals, which we'll cover later in the course. the course is kind of structured for beginners. So, you know, if you are a bit more of an advanced trader, some of today's session might be a little bit basic for you, but we will get to some more advanced stuff as we go along. And likewise, if you're a beginner and you find that you're starting to fall behind a little bit and you're not understanding, just reach out to me. You know, I can point you in the right direction for some resources where you can get caught up and things like that. So hopefully catering to everybody, but again, more sort of geared towards beginners. Next, today we're going to talk about delta dollars, which is a really key thing that I talk about and look at in my trading. Very, very important concept. So that's, again, one of those things that make sure you have a good understanding of it this week or before next week's session, because we're going to be referring back to it quite a lot. And I'll talk about what it is, you know, how to analyze it, things to look for, and things like that. So very, very important, delta dollars. I'll talk about getting good fills on your trades. We'll talk about setting up a trading review system, which is very, very important. Majority of people don't correctly review their trades and track their trades, and that is, there's two main things where people fail, in my opinion. One is not tracking their trades properly. Two is not having a trading plan. So if you can get those two things right, and make sure it's all written down and documented, you're ahead of most other people. So that's very important concepts as well. And then we'll set up a couple of case studies that we're going to look at over the course of the month. So we'll look at the market, even though it's after hours, it's closed now. We'll look at a couple of different trade ideas of these directional credit spreads. We'll talk about how we would set them up, and then we'll follow those along over the next couple of weeks and monitor how they perform. We'll talk about, you know, when and where do we adjust and how do we adjust, and when and where do we set our profit targets and our stop losses. So could be a bit of a long session today. We've got a lot to cover, but I want to make sure we get a good base before we move forward in the course to some of the other topics. Okay, so first up, finding trade ideas. Let me just bring up my other screen here. All right, so a couple of things that I use that we're going to go through today. First is stock charts. It's really, really simple and easy. You don't need to pay for anything. I just have a free account here. Very, very good. So if we look at just a simple chart, you know, a couple of things I'm looking at here on this example, the stocks above the 21-day, the 50-day, and the 200-day moving average. So that's good. They're all trending upwards. So that's also good. Very, very bullish. So quite a bullish looking chart. I've got a couple of indicators on the bottom here. They're not labeled for some reason. Maybe if I need to put the legend on, possibly. But these are two of the money flow indicators that I was talking about. So the first one is accumulation distribution. This just means, is the stock being bought up, or is it being accumulated and bought? Or is it being distributed? Are people selling? And the second one is money flow. Very similar. I won't go into too much detail on how they're calculated, but ideally in a bullish trend, we want to see both of these trending upwards. We want to see the stock being accumulated, assets going higher, and we want to see money flowing into the stock. So yeah, can everyone see my screen? Let me, a few people saying they can't. Okay, cool. So you can see the stock charts. Okay, good. So price is the most important indicator. So when I look at this top section of the chart, looking at the candles, it looks quite bullish. So this would be a stock that I'd consider for a bullish trade. These indicators are secondary, right? My only concern here with these secondary indicators is you can see here, this indicator is declining as the stock's trending higher and money flow is trending lower. So that might give me a little bit of pause. Doesn't mean I can't make a bullish trade on this one, but ideally I'd want to see these both trending upwards. Let me see if I can find an example. If we look at ExxonMobil, now this is very early on in the trend. The 200-day moving average has just started turning upwards. The 50 and the 21 are also turning upwards. The stocks above all of those averages. Very, very bullish action, very bullish price action. So we've also got accumulation trending upwards, and we've got money flow trending upwards in the last month. So this is probably more bullish for me. Now, yes, it's a little bit extended here. The only other one I might look at is relative strength as well. I usually have that up at the top. So it's a little bit overbought. So again, I might not want to get into a bullish trade right now. I might be looking for a little pullback to that 21-day moving average. And that would be quite a good entry point potentially for a bullish trade. A lot of times also in a bullish trend, if you see RSI, it finds support around that 50 level. And in bearish trends, 50 is kind of resistance. It really struggles to get above that level. And in bullish trends, you get these pullbacks and it never really comes below about 50 or 40 on RSI. It never really gets into oversold territory because it's a very, very strong trend. So, ExxonMobil was a great buy, in around here in January, because it's gotten back above all those moving averages. We're getting a little shallow dip here. All those moving averages are starting to trend upwards, and it's had a really great run since then. Still a great stock to be in my opinion. But as I said, I'd maybe wait for a little bit of a pullback potentially before getting into a trade. So that's kind of how I look at things. Then the next thing you can do is look at these candle glances. So how you get to that is up in the top. Let's say we just you can put in up to 12 stock symbols and just separated by a comma. And instead of hitting go, we just change this to candle glance and go. And then we can see just a snapshot of a lot of different charts at one time. So you might have, 12 or 10, I think it's 12 different, tech or growth names. You might have another tab with 12 value names, just basically setting up your watch list like this. And it's a really quick way to just get a look at your charts rather than going through one by one. And then the other thing you can do, which is really handy, is under predefined groups, look at Dow stocks, which is what I've got on the other tab. Now, these are the top stocks in the market, blue chips, highly liquid, very, very good, all very, very good for trading options. So, this is a great way to just have a look at all these stocks. I'll add in RSI here and we'll sort ascending. So now what we're seeing is the most oversold stocks in the Dow are showing up first. Now, this is something that I do regularly. These are quality companies that are just experiencing pullbacks. Blue chip quality companies like this don't stay oversold for too long. And you'll find that, a stock like Walmart might be the most oversold now, but in a couple of months' time, it's probably had a bit of a rally and it's, much further up in the list. Cisco was one that back in late last year was the most oversold in the Dow, and it's had a really good run since then. So a lot of times this is great buying opportunities for these quality companies, right? You look at Apple. Apple's historically been at the bottom of the screen here as one of the most overbought, one of the strongest stocks. It's had a pretty decent pullback here. The highs were about 145. It's currently at 121 or 122. That is, about 16% below the high. So potentially that's a nice time to do more of a contrarian play into Apple, where you think, I'm happy to buy Apple at a bit of a discount here, maybe hold it for the long term and hope that it eventually recovers and recaptures that high. So that's one way to find ideas. And then obviously I've got that set up on one tab. And then in here, once I find a stock that I'm interested in, I can then drill in and maybe have a bit more of a detailed look. Unfortunately, I've lost all my indicators now by redoing that tab, but we can just change that pretty quickly here. Accumulation, distribution, and money flow. So that's really all I do in terms of analyzing the charts. So you can see here, it's in a bit of a downtrend. We've got a declining 21-day moving average. The 50-day moving average is declining. Maybe it's going to find support here at the 200-day. We've got a little bit of declining, a bit of distribution. Money flows come down, but is now sort of holding steady, maybe trending upwards a little bit. So potentially a good time for a contrarian play in Apple. Okay. So a couple of questions. Yeah, so you can set these up as a watch list. First tab I'm going to have is Dow stocks. Next one I might have that one, stock charts. I might have tech, so I might have Apple, Amazon, Facebook, Netflix, Adobe, anything else you want in your tech grouping, right? And then you do candle glance. And then you can add an indicator RSI and sort by RSI. Now, out of my watch list, I've got the ones that are the most oversold. So not so much following a trend, but maybe making a contrarian. Stocks that I've been wanting to get into, now they're starting to pull back a bit. Maybe I can put on a bullish trade on those. And at the same token, you can also, if we go back to our Dow, we can look for, ones that are just starting or getting fairly early on in a bullish trend. Like Dow Holdings looks reasonably good. 3M looks quite good. Microsoft looks pretty good. It's had its pullback now, starting to recover. And then I might look at some of these stocks and say, well, they're pretty overbought here. They have been for a while. Maybe I want to make a contrarian trade on that. I typically prefer to trade with the trend rather than trying to be contrarian. That's what I used to do early on in my trading, was very contrarian. I'd look at this and say, well, I want to sell a bear call spread above because it's really overbought. And I think it's not going to go too much higher. But you'd be surprised a lot of times when a stock's overbought. You can see, Goldman, for example, got overbought in early to mid-Feb and went significantly higher still from there. So trading with the trend is definitely more advisable than trading against the trend. All right, so a couple of other things. FinViz is also really good. I've also started using bar chart as well, which is good, but I'll go through FinViz. They have a really good screener here, which I like to use to find ideas. So you can see here, what I'll do is I'll just take a little screen grab of this. And it'll reset this. So typically I want to be trading large cap stocks because they have the best liquidity for options, okay? So under market cap, first thing I'm going to do is I want to look at, really large cap stocks. That gets us our list right down to a manageable amount. Next thing I wanted to do, you can go onto the technical tab. If I'm looking for a bullish trade, I want stocks where the price is above the 20-day moving average. I want the price to be above the 50-day, and I want the price to be above the 200-day as well. So that cuts our list down to about 19 stocks now. It's much easier to trade stocks that have a higher value. So AT&T, is only $30. It's quite hard to do options trades with stocks that are that low. So if I go to all, I put price. Where's price? Might be under descriptive. Price, there it is. I want to do stocks that are over, say, $40. That cuts us down a little bit more. And a couple of other things that I wanted to do was, I want stocks with good growth potential. So earnings per share growth in the next 5 years, I want it to be positive over 10%. It's cutting our list down again. And I want something that's not massively overbought. So I want something not overbought. So where RSIs come down a little bit. And there we go. There's our list of 5 potential stocks. I can hover over those and get a quick look at the chart. And then if there's something that I'm interested in, I'll go back in here and I'll drill in a bit more detail. And Disney, to me, looks really good. It's above all those moving averages. They're all trending higher. RSI is not in an overbought condition. A little bit of distribution going on, but again, price is the number one indicator here. So Disney's a good potential bullish trade candidate. Facebook has just rallied back above all those moving averages. Money flows ticked up significantly in the last week. That's quite a good sign. Google was another one. Generally looks very good. We've got money flow ticking up again now. We've got, it's got overbought, it's consolidated and now looking to break out again. Google looks quite bullish. And Microsoft also, again, a little bit of concern with the distribution here, but money flow is ticking up, so it's a little bit of a mixed signal. But again, price is the number one indicator. Now, if we take Microsoft for an example, if I want to do a bullish trade, and we'll talk about bull put spreads in a minute, we might use Microsoft as our example. I might put on a bullish trade and I'll use this moving average as a stop loss. So either 230, which is where the 50-day moving average is. There's also clear support here at 225. We can see the prior highs over here, and we can see the low here found support at 225. So, I might start to adjust or, potentially close if it breaks 230. And then if it breaks 225, I'm definitely going to get out of the trade, right? So that's kind of how I look at things, how I find some ideas, and then I'll go and look at how am I going to structure that actual bullish trade. All right, a couple of quick questions. Do I prefer this to IBD charts? Yeah, IBD charts are quite good. I've just gotten used to stock charts, so it's kind of just what I'm used to. But yeah, IBD is great as well if you want to use them. That's fine. Alicia, hey, great to see you here. Yes, you can sort by IV as well. We're going to probably cover that maybe a bit later in the course when we start to talk about volatility, probably next week or the week after. Do I use Thinkorswim? I don't, but Thinkorswim is great. The only two brokers I really recommend is Thinkorswim and Interactive Brokers. Yeah, I do a little bit of back testing. Again, that's a bit more advanced. We probably won't cover that. But yeah, I use a platform called CML Viz for back testing, but that's quite expensive. It's about $130 a month. Next question, what are the levels for accumulation distribution? Just a reminder, anyone who arrived late, if you're asking a question, just change it from all panelists to all panelists and attendees so everyone else can see your question. But the question is, what are the levels for accumulation distribution? I don't particularly have levels. What I'm looking for is a stock that's being accumulated in an uptrend. If we look IWM, the Russell had a good example of where back through here, it's making a series of higher highs. You can see that here, it's hit overbought status 3 times and money flow is kind of declining. So that was a little warning sign here that we had this little decline. That decline's happened now and we've worked off those overbought conditions. You can see again, RSI, it's not really getting much below 50. So very, very strong bullish trend. It's also breaking out above that prior high. So IWM looks very, very bullish. The only concern is this declining money flow, but you can see accumulation's kind of been ticking up since about October. We get these little dips, but generally trending higher. So, IWM looks very, very bullish. Yeah, CML Viz was the software I used for backtesting. And then OptionNet Explorer as well, which is more of a manual backtest. It's a little bit cheaper as well. You can go through trades one by one, and we're going to cover that probably next week as well. All right, so we've got a couple of examples there of bullish stocks that we might want to look at. Hey Tim, yeah, I use all three to detect divergence: RSI, money flow, and accumulation. If all three of them show divergence, that's a really strong divergence signal. Whereas here, only one of them was really showing divergence, so it's a bit of a mixed signal. But it's just taking that into the overall picture. Back here in mid-Feb, I'm not necessarily going to open any bullish trades, or if I do have a bullish trade on, I might have a pretty tight stop loss because of that. It's just trying to, price is the number one indicator. Is the price trending higher? Is it above those moving averages? Are they all trending upwards? That's my number one concern. And then these other indicators are kind of secondary. Pritesh, OptionNet Explorer was the second one. We're going to have a look at that next week. So I'll show you how to use that. Yeah. Okay. So if we go into Interactive Brokers, which is my broker, I'm going to show you how to set up a bullish credit spread on one of these stocks. So a bull put spread. We'll use IWM because that actually looks really bullish breaking out. So what I'll do is I bring up the option chain. The March expiration is going to be too short term. March 19th, only a week to go. I never really trade that last week. I want to be sort of around that 35 to 45 days to expiration is kind of a sweet spot. Typically for me, I'm going to look at about anywhere from a 15 to a 25 delta as the short option, depending on how aggressive I want to be. So we'll look at a couple of examples. I'll add in a few options here. And 205. So we've got the 205, the 210, the 215, the 220. There's our delta here. We'll get to the Greeks maybe next week, but hopefully you have a little bit of a base understanding of the Greeks. You can use delta as a rough estimate of probability. So the 220 put for April has a roughly 28% chance of expiring in the money. This one has a roughly 17% chance. It's not exact, but you can use it as a rough guide. So those are the strikes that I'm interested in. I don't worry too much about the option chain. What I want to do is I want to look at the expiration graph. That's my number one concern. So anytime I'm interested in a trade, I want to come in and I want to analyze the risk graph. So let's say we go with selling the 20, let's go with the 15 delta. That's pretty standard for me, or 17 delta, that's okay. I typically want to stay to the 5-point strikes. Can you see the volume and the open interest is quite a lot better? So 46,000 open interest there, 205, whereas open interest here is only 8,000. Still really, really good volume, but it just helps in terms of getting better fills on your trades when you're trading these really highly liquid ones. So try to stick to the 10-point strikes. Even though that's not 15 delta, the 208 is the 15 delta. I'd probably go with the 210 because it's a more highly traded strike price. So pretty simple trade setup. We buy 2 of those, we sell 2 of those. And there's our expiration payoff graph, risk graph, whatever you want to call it. Okay, so again, we sell the 210 put and we buy the 205 put. You can see here that's generating about $120, $130 in premium, and we've got about 880 at risk. I always, on a credit spread like this, I always want to have a minimum sort of 10% return potential. So if I take, let's say 120 in premium over 880 at risk, that's about 13.5%. So that ticks the criteria for me. And that's a pretty decent trade setup for a bullish trade. The line I've added here in purple is what's called a T+0 line. This basically just shows me what does the trade look like as of today. Obviously, it's a bullish trade. If the stock goes up, I make money. If the stock goes down, I lose money. Okay. I always want to look at this in terms of, where's my risk? If a trade like this, I'm earning or generating $120 in premium, I typically don't want to lose about 1.5 to 2 times that amount on a trade. So if I see where that T+0 line comes in at say 150 to 200, you can see that here on the left. This is how much I've lost if the stock drops today or say tomorrow. And that's kind of where I want to set my alert. So if I go, this will be different for every broker, but you can usually find a risk graph like this pretty easily. If you've got interactive brokers, obviously great, you can set things up exactly like this. So that sort of $150 to $200 loss comes in around here between 215 and sort of 217.50. All right. So that's where I'm going to set an alert. If IWM hits this level, then I'm going to have to look at the trade again. Okay. So that's how I do that in terms of setting a stop loss. What I might also do is look at, what does the trade look like a week from now or 2 weeks from now? You can see a little bit better. Still kind of similar around that level, about 217.5. Okay. So that's kind of the first thing I do before I get into any trade. I just look at things, make sure I'm happy with the setup. Am I generating enough of a potential return? Where's my risk? And that's kind of what I'm looking at. Then if I want to actually place this trade, I'll go back to my main screen and I'll set it up as a combo. Again, it's going to be slightly different for every broker, but very, very similar. Sometimes IB is a little bit slow, so just wait for this to come up. All right, there we go. So I'll choose my expiration date. We're trading puts. The strategy is a vertical spread. Now IB is a little bit backwards, but you do get the hang of it eventually. I know I found this confusing at first years ago. When I started with IB, it is a bit overwhelming, their platform, but it's actually really, really simple when you get used to it. You have to kind of do it the opposite way around. So you have to say you want to buy the 210 and sell that to create the spread. If I do it the other way around, which is what we actually want to do, we want to sell that one and buy that one, nothing's going to show up. So you have to do it the other way around. And then what you do is you add that one And what we want to do is sell that spread, okay? So if you hover over it, it gives you a little cheat sheet. So to buy means to buy the 210 put, sell the 205. We want to do the opposite. So we want to actually sell that spread. And to sell, we just click on the bid. Normally during market hours, we'd see a bid price, a mid and an ask. A little bit annoying that they don't have it here. We can kind of just look at the mid price and work out roughly what the price is. So if we sell at 342 and we buy at 262, that's about 80 cents. All right, so I click on the bid to set up my sell order. I know the midpoint's about 80 cents. Now, I don't necessarily want to get into this trade right at the midpoint. And IWM is going to fluctuate up and down during the course of the day. So, instead of putting my order in at 80, I might put it in at say 90 or 95 and leave that sitting there for the day and see if it gets filled. So that's how you can get filled at a better price sometimes, rather than just going straight in and trying to get filled at 80. I'll just leave it sitting there. Sometimes, the stock or the ETF might rally, the price keeps dropping in and you've missed the trade, and that's okay. Sometimes you're going to miss trades. There'll always be another trading opportunity. But if you do this, sometimes you can get filled at a slightly better price, much better than getting filled at 75 and trying to force the entry into the trade. You might get filled at 70 or 75, then IWM drops and all of a sudden this has gone to 90 or a dollar. You're already losing money right out of the gate. So just a little tip there. Then we can hit transmit. That order will go live into the market, change that quantity to 2. And then once that gets filled, if I just add IWM stock, again, different for every broker, but I can come in here, set an alert. If IWM drops below 217.50, I'm going to get an alert if that happens, right? So again, that's down about here. Hey, Charles, so $200. I'm setting my alert based on the premium, which was 120. I typically don't want to lose about 1.5 times that. So roughly 200. I look at 200, comes in around 215. I want to set my alert just slightly above that. So about here, 217.50. Now, once I'm into this trade, I can just leave it alone. Don't even really have to look at it unless my alert gets hit. If my alert does get hit, then I have to come in and decide, right, am I going to take the loss early? Am I going to try and adjust it? What am I going to do? And that's something you should really have planned out in advance, but we'll get to adjustments and trade management as we get further along in the course. Good question here from Michael. So how would you decide to do a bull put spread versus a bull call debit spread on a specific name? Both are bullish trades. 10% return makes you indifferent, or would you look at something to see which is better? It's typically better to do a credit spread if volatility is high and a debit spread if volatility is low, but I'll show you something interesting. There's actually not a huge amount of difference depending on where you put the strikes. So at the moment we've got the put spread. What if we used calls instead? Let's have a look. So to do a bullish trade, we'd buy 2 of these, we'd sell 2 of these, pretty much exactly the same trade. Hopefully you can see that this one's actually generating slightly less in profit potentials, more like around 115, 110, but pretty much an identical trade. So it doesn't really matter whether you use calls or puts, it's effectively the same trade. The only difference is these options are in the money. So you've got assignment risk now with this one, and we don't really want to get assigned. It's not a massive deal. If you do get assigned, you can deal with it. But someone might come in and say, I'm going to exercise this option. Now, all of a sudden, this option gets removed from your account and you've got a negative 200 shares position. Doesn't happen very often, but it's obviously more likely to happen if the option's in the money. So that's why I would use calls in this case, puts, and I wouldn't use calls. Hopefully that answers your question. Okay. Do I know the max loss and the max gain? Yeah, so a credit spread, anytime you've got options in the same expiration period, we know the maximum loss. IWM can go to 0, and the most we're going to lose is $880. and IWM can go to 300, the most we're going to make is whatever it is, 120, 125. Yeah, exactly. So it looks like this is, because it's after hours, the prices are slightly off. So it's saying this one's 260 and this one's $2. So it's actually only saying we're generating $60 in premiums. That's a good catch, actually, Eric, or 120 in total. But if we put our order in at 90, we're actually going to generate $180 in premium. So that's absolutely right. I think because there's no prices here, because we're after hours, there's no ask price. IB is just looking at it at $62. So actually this trade looks even better if we can get filled for 90, right? We're actually, this profit is going to go up here to about 180, and the loss potential will be 1,000 minus 180, so 820. So yeah, this is actually, trade looks even better based on getting filled at that price. Yeah, great question, Tim, as well. What in terms of profit percentage? So there's one real main rule that I have with taking profits. If I've achieved 50% of the potential gain in less than 50% of the time, I'll take profits. And that's on the flow chart as well. If you go back to that members page, the flow chart for the bull put spread, that's there on our profit taking rule as well. So let's say we get filled for 90 cents, 2 contracts, we're generating 180. If I've got a $90 profit on the trade in less than half the time, I'll take it and close it out and redeploy the capital elsewhere. So let's say today's the 11th of March in the US. The expiration date's April 16th. I'll just go into Excel and I'll just say, right, that's about 35 days. So today plus, say, 17, 18 days, that's going to be about March 29th. So again, I'll check in on this trade, and if I've got $90 in profit for the trade before March 29th, I'll close it out. Hey Charles, yeah, so you could redeploy in the same trade potentially, or you could find a different opportunity. If Russell's rallied a lot and it's looking quite overbought, you know, I might not want to reallocate to Russell or IWM. I might look for something else. It just depends on how the charts look at the time. All right, so that's one example. Sorry, one more question from Tim. What percentage of total risk are you going for? Percentage of risk. No, I'm talking about in terms of profit, percentage of the premium received. So 50% of the premium, not 50% of the capital risked. If you need more help on that, just shoot me an email. Yes, is there a way to hedge debit spreads? There's ways to hedge any trade, and we'll get to sort of hedging and adjusting in the coming weeks. It's a bit more advanced. I want to just get the basics down today. All right, so let's compare this trade with more of a longer term trade. So one thing I like to do is, as I said, talk about the return potential, right? So let's say with this trade, we're generating 180, we've got 820 at risk, we've got a 21% return potential, okay? We're in the trade for say 35 days. It's 35 days till expiration, March 11th to April 16th. 365 days in a year. Sorry, wrong way around. We can potentially do 10 of these types of trades a year. You know, that's a huge return on a yearly basis, right? Now you have to factor in, you're going to have losing trades and adjustments and all sorts of stuff. And this is only one small trade. You're not going to risk your whole account, right? So you can't be expecting to get a 200% return per year. But let's compare this with a different style of trading. Let's say we're bullish on IWM, but we want to go for more of a long-term trade. Let's say we go really long-term. Now, not a lot of people do this sort of thing, but I actually really like these types of trades. Let's find our 15 delta. There it is there, 175. All right, so let's just turn this one off. By going further out in time, we can get much further away for the same delta. Change our expiration date. Much different looking trade now. Well, similar in terms of potential profit and potential risk, but we're having to wait a lot longer. So our theta is very low. But look at the difference in that T+0 line. This trade compared to the first one is going to move very, very slowly. So you can see with this one, Russell or IWM could drop 5% tomorrow, and we're going to be down less than $50, maybe about $40, right? Compare that with this one. Here's our T+0 line. IWM drops, we're going to be down over $100 on this one tomorrow. So see the difference between the T+0 line? That's our monthly trade, and that's our long-term trade. We can withstand a lot of a big drawdown before we have to really even do anything with this trade. So it's a different style of trade. Profits are going to be, well, the dollar profit is the same, but the annualized return is a lot lower. So if we look at this one, this is, let's say, generating 150. Again, I don't know if those prices are good. It might be slightly higher. It might be more like 180. Let's assume it's 180. It's the same return, but we've got, how many days to expiration was January? January 22, 315 days. So we've got 315 days to expiry. So we can do 1 and a bit of these trades per year. We're generating a 25% annualized return. Okay, so still a really healthy annualized return, and we've got a much bigger margin for error. We've got 25% drop that we can withstand between now and January, whereas with this one, we've only got about a 10% drop. It's just a different style of trading. I'm not saying one's better than the other. The difference is going to be this trade's going to move a bit faster. So if Russell drops, 5 to 10%, all of a sudden you're down here, down $300. Let's say Russell drops 10% and you've got this one, you're only down, $60 or $70. So I like a little bit of this type of trade going a little bit more long-term because it's a bit easier for me to monitor the trades because I'm in Australia. It's quite hard with the time difference. I can't be in front of a screen all night watching these trades. These ones move very, very slowly. And if we compare that with a weekly, I know a lot of people are attracted to weekly options. Wrong one, sorry. I absolutely 100% avoid weekly options. And even with these spreads, if I've got this April one open, I'll close that out before it gets to the last week, even if my profit target hasn't been hit or my stop loss hasn't been hit. I really don't want to take it into that last week. So let's say we were going to do a weekly. We'll do the same, about a 15 delta. We'll use this, even though it's not the 5-point strike. So, similar trade, generating around that $100, 900 risk, but we've only got about a 5% margin for error, and the T+0 line starts to drop off pretty quickly. Russell can move quite fast. If it does drop 10% in a few days, we're down $650 on this trade. With the monthly trade, we were down about $275. With the really long-term trade, it's hardly been touched at all. We're only down about $80. So yeah, there's always a trade-off. So gamma and theta go hand in hand. And you don't have to worry too much about what gamma is exactly, but gamma is just basically price risk. So high theta equals high gamma risk. So it's always a trade-off. Yes, you can look at this and say, yeah, I'm going to generate a huge return. If we look at this, let's say 110 over 890. We've got, say, 7 days to expiration. We're generating a 12% return in a week, potentially 600 a year. You might look at this, and a lot of people are attracted to this when they first learn about options and spread trading, and a lot of marketing hype plays up on this as well. But these are very risky trades, And I've heard so many stories of people who, will email me and they say, oh, I was trading weeklies and, I was going great. I had, 8, 9 winning weeks in a row. And then that one losing week completely wiped out all the gains from those other weeks, right? That might be your style. That's fine. I'm not saying weekly options, you should never trade them. You just have to be aware of the risks. There's a lot of price risk. Yes, you can generate, it's finance 101, right? High return equals high risk. Medium return, I mean, it's a very high return, 220%, but you're taking risk as well. Much lower return, much lower risk, right? Yeah, so Michael's got the same story with the weeklies, right? So not saying it's right or wrong. I'm not saying these longer term ones are right or wrong either. This is a nice sweet spot that's sort of 35, 40, even 60 days. It is a great place to start. Try and avoid the weeklies if you can, if you're just learning. You'll find out from experience that these move very, very quickly, particularly, if you're working full time still, you got meetings, you can't be monitoring these trades. You might come back from a meeting, all of a sudden the Russell's dropped 3% and this trade's been crushed, whereas this one won't have been impacted as badly and this one will have hardly been touched at all, right? So that's the 3 different styles of trading in terms of time. Now, the next consideration is maybe you want to go slightly higher delta. So let's look at the difference here. Say we go back to our monthly with April, but we want to be much more aggressive. We think Russell's in a really strong trend. We're going to go with like a 35 delta. We're going to go much closer. We're going to buy 2 of the further away. We're going to sell 2 of the closer. And we've got a slightly different style of trade again. We're generating a higher premium, about $270, and therefore we've got a little bit less risk, $730. T+0 line's actually pretty similar, I think, between the two. If you're really bullish, you can definitely go a little bit closer if you want to take a bit more risk. So now's probably a good time to talk about delta dollars. So make sure you're paying attention because this is pretty important. So this trade has delta dollars of 3491. So let's get rid of that. Okay, 3491. This trade's got 1809. So what's the difference? Okay, what does it mean? So delta dollars, we've got 3 delta columns here. We've got delta dollars, we've got delta of the option, and we've got our position delta. So this one is just the delta of that particular strike price. So this is a 17 delta put. Okay, again, that's kind of roughly reflects it's got a 17% chance of expiring in the money, or a roughly 83% chance of expiring worthless, right? Because we're trading 2 contracts, we take -2 times -17 gives us +34. That's what's called our position delta. Then we take that 13 delta plus 2 contracts times -13 gives -26. We combine the 2, our overall position delta is 8, okay? If we were just trading a cash secured put or a naked put, we'd have delta of 34, okay? But we've got a spread, so we combine the 2, overall delta of 8. Now it's probably 8 point something or 7 point something, but roughly speaking, if we take 8 times the price of the underlying, 233.06, that roughly gives us our delta dollars, okay? Same with the other one. We've got a 35 delta, 2 contracts, so delta position delta is 71, 2 times -28 is 56, our overall delta is 15. 15 times 233.06 is 3495, so pretty close to what we're getting here. Again, it's probably 14.95 or something, right? Now, I think Interactive Brokers is the only one who reports delta dollars. I think TOS might have it, but they call it maybe delta notional or something like that. But if you don't have it, very, very easy to calculate in Excel. You just take the overall position delta times the stock price, gives you delta dollars. What does it mean exactly? Well, it's a risk parameter that I look at. If so we've got delta 8, delta 15. This position here with delta of 15 is roughly equivalent to owning 15 shares of IWM. So it's always good to just refer back to how much exposure you're taking. Delta dollars of 3492 means it's roughly equivalent to owning $3,492 worth of IWM stock or ETF, right? So I want to always relate this back to my account size in terms of how much risk I'm taking. Let's say I didn't really know what I'm doing. I got a bit greedy and maybe I just go in with 10 contracts. I'm really confident on this. I've got delta dollars of 17,000. What if my account size is only $5,000? That's a massive exposure compared to your account size. It's 3 times bigger than your account size. Now, don't get confused with delta dollars and max loss. The most we can lose on this trade isn't $17,000. It's still 3,600, right? But this is our roughly our notional exposure to the underlying. And what we look at is we say, right, if we've got delta dollars of that and the Russell tomorrow drops 1%, I'm going to lose roughly that times that. I'm going to lose roughly $174. And if my account size is only 5,000, I'm going to lose 3.5% of my account. Does that make sense? So if this was 5,000, it would be sort of a 1-to-1 ratio. At the moment, it's 3 and a bit times my account. So my losses in my account in percentage terms are going to be magnified. All right. So I always want to relate delta dollars back to my account size. I've done that the wrong way around. And when we get to iron condors, there's other things that we can use this delta dollars in terms of monitoring our risk as well. All right, so we'll cover delta dollars in a little bit more detail over the next few weeks as well. And there's some reference articles you can read on that as well if you want to go over that in a little bit more detail before next week. But very important to understand how it's calculated and why we might use it. Yeah, good question. So yeah, let's say you've got 100,000 account size. Now, for any one position, I might have a rule where I don't want delta dollars to be more than about, say, 8% of that account, whatever you want to make it. And then my overall, my general rule is my overall delta dollars across my whole portfolio is I don't want it to be more than plus or minus 100,000 1-to-1. If it gets above my account size, I'm basically trading with leverage, right? Now, a good level might be, say, 20,000. So that's across all my positions. You know, I've got that. I've got basically 20% of my account exposed on the bullish side. Now, other people might want to be completely neutral. They want to try and keep delta dollars close to zero. So they've got lots of different exposure across different trades, but their net exposure overall is zero. So I'll show you what I mean. Let's say we'll go back to our original position. It's got 1,800. Let's say, you know, that's a very small exposure on a $100,000 account, right? But let's say I want to trade completely delta neutral. Well, what I'd look for something that, go and find a chart that I think looks bearish. You know, just trying to think, J&J is hitting resistance there. You know, I typically don't want to bet against Dow stocks too often, but you know, maybe let's just use J&J as an example, sort of first one that's come to mind. So I'll come in here and I'll do a bearish credit spread on J&J. I'm going to choose the same expiry. I want to be similar, roughly around a 15 delta. I sell the closer in one, I buy the further out one. Now I've got negative 2,400 delta dollars on J&J. It's brought my overall delta dollars closer to zero, slightly negative now. If I didn't want to have negative, maybe I wanted to have slightly positive delta, maybe I just do a 1 contract, even though that's not a whole lot of premium, but then we've got slightly positive delta now. So I'm always looking at, you know, the overall portfolio. If I start to get too much bullish exposure, if I start to get too much positive delta, you know, I'll add bearish trades to add negative delta to the portfolio, which brings us back closer to zero. Likewise, if you know, the market's really rallying and I'm getting hit on all my bearish trades and my delta dollars is getting really high negative value, I'll add some bullish positions to bring that negative delta down. All right, the other thing in terms of delta and delta dollars I want to talk about is again the difference between position delta and delta dollars, and why it's important to look at delta dollars as our sort of number one exposure indicator. All right, so let me give you kind of an extreme example to illustrate the point. We've got delta of 8 here on IWM. So let's go into Amazon, which trades at about 3,000. And let's just do, again, this is not something I would do, just for an extreme example. Let's say we add this 8 delta and we sell that one. Naked call, not recommended at all ever. But if we ignore delta dollars and this delta column, we just look at position delta, we say, right, delta 0, awesome. I've got a perfectly neutral portfolio here, my delta's 0. Well, actually not really, because your exposure to Amazon is a lot higher because it's a higher value stock. So overall position delta is 0. I've got plus 8 delta here, I've got minus 8 delta here, overall 0 delta, but my actual notional exposure is very, very negative. Right, and you can see that here by the combined risk graph. You know, you can barely see the put spread on IWM. You can see all of our risk is on the upside. We've got huge negative delta here, right? So when you're looking at your portfolio, never look at this and think, oh, I'm delta neutral. Always look at delta dollars. Yeah, it's beta risk, yeah, essentially. Okay, so that's sort of the example I give to really illustrate that point of why delta dollars is so important. And if I've got a $5,000 account and I've got 23,000 negative delta on Amazon, you know, that's a huge exposure. I've got a huge amount of risk. Amazon rallies 5%, or let's say 7.5%, all of a sudden I've lost my entire account, right? So what we want to do is we want to have some bullish trades on stocks that we're bullish on. We want to have some bearish trades on stocks that we're bearish on, and overall roughly delta neutral. And what we want to do is we want to maximize theta, right? This is the most important. This is what we all care about. This is what we all want to achieve. Time decay. We want to make money through time decay. And we want to keep these other Greeks, minimize these Greeks, maximize this Greek, right? And then when we get to further along in the course, we'll talk about neutralizing Vega as well by positive Vega trades. Because credit spreads, if we add lots of bull put spreads, lots of bear call spreads, they're all negative Vega. So then we want to sprinkle in some positive Vega trades to help offset our volatility risk. So we want to manage our price risk, which is delta dollars, and eventually we want to talk about neutralizing or minimizing our volatility risk. Okay, any questions? All right, so we have gone through some pretty advanced stuff there. So if some of that's gone over your head, don't worry too much. Just drop me a note in the chat room or an email, and we can go through it together, or I'll, you know, point you to some reference material. Okay, so we'll talk about Vega as we go along, but yeah, just to repeat what I was saying, we want to neutralize our price risk, which is our delta dollars. We want to keep that fairly low, and we want to try and keep our Vega risk pretty low as well, and we want to maximize our theta. Okay. So again, as we start going through and adding different positions, J&J was the one that we looked at. You know, I haven't really got many other bearish examples, but anyone got a stock that they're bearish on? I wonder if we can do the opposite here. If we go price below, price below, price below, not oversold. No, we haven't got too many there. Adobe. Yeah, Adobe's one. It's potential. A lot of tech is obviously performing pretty poorly at the moment. So Adobe's below all of those moving averages. It's just got below the 20. Money flow's picked up a little bit, but it's distributing. Maybe, you could do a bearish trade on Adobe. I don't love betting against such great companies and great stocks. Tesla, yeah. Yeah, Tesla Zoom. Let's have a look. Yeah, Zoom, it looks quite weak. We've got declining 20, declining 50. It's below all of those. So yeah, not a bad one. Tesla as well, bumping up against the declining 21 as resistance. We've been in an uptrend. RSI is holding around that 40, 50 level. Now we're in a downtrend. Maybe 50 is going to be resistance. So yeah, potentially Tesla. Tesla and Zoom. So yeah, good potential candidates there. Let's look at Zoom. Roughly 15 delta there, 10 points apart. So we probably only trade the one contract. -1, +1. We're going to do the 2 there. So now we can see we're building out our portfolio. We've got 3 positions. We've got 1 bullish, 2 bearish. So we're starting to get negative delta dollars. Another thing I want to talk about, and I'll actually use IWM as the example. In terms of selecting the strikes, why did I choose 5 points apart? That's something that I usually want to look at as well. Again, there might be a bit of noise here because the after hours pricing might not be 100% accurate, but is there any difference between going 5 points wide with 2 contracts or going 10 points wide with 1 contract? So we can see here we're generating, well, it's telling us 120. We know it's going to be more like 180. If we do 1 contract, it's pretty similar, maybe slightly lower. Usually when you're doing 1 contract and wider, it's going to generate slightly lower premium. So generally it's better to be as close together as you can and trade a couple more contracts, particularly now as commissions are so low. 10 years ago, this used to be a bit of a factor. When commissions were higher, you'd probably prefer to trade 1 contract and pay less in commissions, because don't forget you're paying commissions on trade entry, trade exit, anytime you adjust. But for now, I think 5 points wide is slightly better. You can see we're generating slightly more premium. No, less than 5 is okay. Like you could do SPY, trades in 1 point intervals, IWM. Yeah, that can be okay as well. Just keep an eye on, how much your broker's charging you for commissions and things like that. Yeah, you can do unbalanced ones as well, Michael. Yep. And we'll probably talk about that and touch on that when we do condors. Like you could trade, 2 contracts on the put side and 1 contract on the call side to give the trade slightly positive delta. Yep. So Zoom, we saw we only had 10 points wide available. So we have to just trade the 1 contract. And, slightly different looking trade, because let's add another metric in here. Implied volatility. Implied volatility in Zoom is a lot higher. So you can see here we've got a trade where we're getting way further out of the money. And the reason for that is because it's a stock that moves around a lot more. It moves around way more than Johnson & Johnson does. So another thing you can look at in terms of your risk, I'm going to try and remember where it is. Beta delta dollars. Again, this is sort of more advanced stuff, but if we go back to look at our whole portfolio, maybe you want to get rid of that one. We can get rid of that one. So this is telling us what is our beta delta dollars. So we've obviously got a lot of negative delta dollars in Johnson & Johnson, but because it's got a low beta, it moves a lot less than the S&P 500 generally. We've got slightly lower beta delta dollars. So again, that's a bit more advanced, but that's something you might want to consider as well if you're trading a lot of high beta names. Like it seems to be a bit of an issue here with Zoom. Like I'd say Zoom would be a much higher beta than that. Normally I'd expect to see delta dollars here of Zoom of 742. I might expect to see beta delta dollars of like 1500 or something, because it probably moves, twice as much as the S&P 500 does. So that's another thing you can look at as well once you start to get a bit more advanced. It seems to be some sort of problem there with Zoom for some reason. You can see here 2 bearish trades, 1 bullish trade, so overall slightly negative delta. Then maybe you want to add 1 more bullish trade. You know, 16 delta, 5 points wide, 2 contracts. Now we're, overall our delta dollars is really good. We're pretty neutral. We've got 2 bullish trades, 2 bearish trades. I think I've got everything set up correctly. That T+0 looks a little weird how it's dropping off to the left, but maybe there's something I'm missing. But anyway, maybe because this is quite a lot closer in price than say the Zoom one. But in any case, so with those trades that we've looked at, again, I want to look at each trade individually as well. And I want to set my alerts. Say for this one, we're generating, say, roughly $100. Don't want to lose more than about 150. Again, it's going to come in, a couple of percentage points above that short strike. So usually, 165, 166 is probably where I'm going to set my alert for Johnson & Johnson. Again, these are not trade recommendations or anything like that, but we will use these as our case studies for the month, and we'll see how they perform. Generating about 100 on this one. My alert's going to come in around here about 57, which is pretty close. I actually don't really love this trade, to be honest, but we'll see how it goes. And then for Zoom, much bigger margin for error, but that's because the stock can move a lot more. Generating about 100. Don't want to lose more than about 150. So sort of around 405, 410 is where I'm going to set my alert. So yeah, always looking at each individual position, and then you want to look at your portfolio as a whole. What's my overall delta dollars, which is good. Now, this is the point I was making about Vega. We've got negative Vega on all of these trades. So you might want to potentially add like a calendar spread or something like that to bring the Vega down. I'm not sure how to do it on TOS. I can probably ask for you. I know heaps of guys and girls who use Thinkorswim. So I could probably find out for you. Or if there's anyone else in the group that knows, yeah, chime in. So looking at the overall, the only real concern is this drop off in the T+0 line is because that XOM position is quite close. If we took that off, it's a much flatter T+0 line. So I actually don't really love this trade idea, to be honest with you. So I'd probably leave that off. We've got a little bit of overall negative delta. That's okay. So I think this might be our starting position. I must have had more risk or something in one of these trades because we've got only 700 at risk on the upside and 700 on the downside. So it's quite even in terms of our risk. I'm not sure what I did wrong exactly there. But those will be our first 3 trades that we'll follow along with. Thanks, Michael. You've just got your comments set to all panelists, so no one would have seen that, but he's saying only see it in the monitor tab, not the risk profile for portfolio. Let me just copy your comment there and repost it. Yeah, there could be some issues with after hours pricing as well, for sure. All right, so we're getting on in time a bit, but we've almost covered everything I wanted to cover today. The next thing is, we touched on it at the start, why are we looking at, mega cap stocks? Why are we looking at Dow stocks, high volume stocks for trading our options? Let's look at an example. IWM bid-ask spread 195 to 202, very, very tight spreads. Let's look at Lulu, I think is a good example. Pretty popular stock, Lululemon, spreads are really wide. Let's look at, there's our 15 delta. We'll look at just the 15 delta as an example. So our 15 delta here is 260, 264, 4-cent spread, very, very tight. Here we've got 235 to 281, more like a 50-cent spread. So much harder to get good fills on Lululemon. So when you're starting off, try and stick with, IWM, SPY, QQQ, Apple, some of these highly liquid stocks that have much better bid-ask spreads. It's going to be much easier to get good fill prices. So just keep that in mind as well. And then you want to look at open interest as well. You know, I talked about those long-term trades, you know, on certain stocks, they maybe don't make much sense because you might go out here. Lulu's actually got a little bit of open interest, but, you know, pretty much zero volume for the day in a lot of these puts. But you'll find some stocks, you know, wide spreads and very little open interest, zero open interest. You never want to be the only person who's got a position in that option, right? Because when you come to try to close it, the market makers will go, oh, he's the only person who's trading in this. I can just set whatever price I want, and they'll really gouge you on the price when you're trying to get out, right? So yeah, those on TOS, you can analyze your position and select whichever trades you want to see the risk profile for, including trades you haven't placed. So there you go. And yeah, YouTube, I'm sure there's something on there. Yep. Hey Charles, have I been assigned before? Yeah, a few times. Look, it's always a bit of an annoyance, but it shouldn't be something you should be overly scared about. A couple of things you can do to try and avoid that. Let's take our IWM trade as example. Never let the stock get below 210, right? You're generally not going to get assigned unless the stock's below 210. Let's say it's trading at 215. No one's going to assign, no one's going to want to buy the put or sell the put for 210, sorry, if it's trading at 215. They'd just close out this option and then they'd sell the stock in the market for 215. Yeah, European options can't. So RUT, SPX, NDX options can't be assigned early, but IWM is an ETF and it's an American style option, so it could technically be assigned early. So that's the first thing, is always make sure you don't let your spreads go in the money. You should never let them go in the money anyway, because we're setting our alert, you know, 215, 217. So we should always be either adjusting or getting out of the trade well before it hits our short strike. So it really shouldn't be an issue. But if on the odd chance, maybe you're away on vacation, whatever, IWM drops all the way down to 200, and it typically only happens quite close to expiration as well. If there's any time value left in the option, it's better for the person who owns this put to sell it in the market rather than to exercise it. So again, just, you know, if you're on vacation, something like that happens. If you get assigned, you're then going to have a 200 long position in the stock, and you'll still have this one. You can just close everything out, and it's, you know, more or less a wash. You know, there'd be some commission costs and stuff and a bit of noise there, but, you know, it's not really something that you should fear. Where it gets a little bit annoying is if you've got like a butterfly spread and you get filled on the middle strike, you know, that can be a little bit annoying. Yeah, European indexes are European options, and they settle automatically in cash. Yeah, exactly. So there's no assignment because there's no stock that can be assigned for an index, right? Whereas IWM, even though it's based on an index, it's actually an ETF, and you can get assigned and take ownership of that ETF. All right, last thing, there's one more thing. Let me try and open this up. Should have had it ready. You all have access to this to download on the members page, but here's a lot of you will probably have this already anyway, but this is where you can track and review your trades. Link there to download all my books if you haven't got them already, the Amazon books. So basically you'd come in here, trade date, 311 or 312 gets filled tomorrow, whatever. IWM, April 16th, strategy, bull put spread, trade details. You know, I usually just put 210 put, 205 put, you know, something like that. Entry price 180, hopefully. Risk is going to be that minus that times 100. And then we put in our 2 contracts. No, what am I missing? It's actually risk, what would you say, 820. You can work it out easy anyway, don't need to formula it. And then when you close it out, exit date, closing price, P&L, and your return, and any notes, like if you adjusted it, anything like that, you can also put that in here. So that's where you start to track all your trades. And then eventually you'll have this big database of trades, and you can, filter by the strategy. You can see how you're performing on each one, and then you can start to see, maybe trends emerge where I'm really good at bull put spreads, but I'm not great at iron condors, or I'm really good at iron condors, but I'm having no luck with calendars. So, you stick with what's working. So really important to track and review trades. And then as we go along, I'll show you another way with each individual trade. What I always do is take a screenshot of this information of all the Greeks and the risk graph at the start of the trade. And then anytime I adjust, I put in some notes, why am I adjusting? How am I adjusting? And I'll take screenshots before and after as well. And then again, you have this big database of trades and information that you can refer back to. And, 3 months down the line, you might say, oh, I'm in this situation with this bull put spread, and I remember a similar situation and I did completely the wrong thing and I really messed it up. So you go back and refer to that document. You're like, oh, okay, that's what I did. Don't want to do that again. I don't want to make the same mistake. And you do it an adjustment correctly. So that's a really good habit to get into. And again, most people won't do it, but it will make a big difference, trust me. So I'll show you some examples as well as we go along. I'll get these all set up and posted on the members page. So here under the case studies, I'll have the links to these 4 examples that we've set up and the replay in here. Yeah, Michael, so the 10% return we were talking about is the premium that we're bringing in. 120 over 880 risk was about a 13.5% return, I think. So always want that to be more than 10%. And actually we talked about, potentially getting filled at 180 on this one. So the return's actually higher than that. All right, so we've gone through a huge amount today. I hope you're not feeling overwhelmed. I hope you've learned a lot already. There's lots more good stuff to come. If you are feeling a bit overwhelmed, just reach out to me, let me know. I can walk you through any concepts. Watch the replay again as well. If there's anything that we went over that wasn't quite clear or you need to refresh on and go back over, definitely a good idea. Other than that, I'll keep you posted. Make sure you're getting my emails. I'll send an email out probably in the next hour or so with the replay. So make sure you get those. And again, remember to just add my email address to your address book. Yeah, Discord is a great place to ask questions, Michael. I actually prefer that because then everyone else in the group can benefit from your questions. It's fine if you want to ask questions privately on email, totally fine. But again, probably preferred if you do ask it in Discord, everyone else will see the question and the answer as well, so they'll benefit as well. Okay, I think that's about it. Unless there's any other questions, I'll stick around for another couple of minutes if there was anything that you wanted to ask before we sign off. But otherwise, if you think of something later, yeah, Discord or email. Thanks, everyone. Thanks for the feedback. Glad you enjoyed the session. Lots more good stuff to come over the coming weeks. Hey, Wayne. Yeah, it's been good working with IBD for sure. Yep. Yeah, obviously quite a privilege to be kind of their main options guy, right? So yeah, it's been really good. That's another great resource as well. If you're, I actually use them quite a lot in terms of, looking at their ratings for particular stocks. Let me see if I can find an example. So again, this would be something you'd potentially have to subscribe to, I think, to get these examples, but they've got a great write-up on each stock, and I love their sort of composite ratings. Trying to think of some of their highly rated ones at the moment, and they have a leaderboard as well. Yeah, HZO, yeah, exactly. That was one I mentioned in Twitter. So DraftKings is pretty good, low on the EPS rating, but yeah, HZO is on top of the leaderboard, I think, at the moment. So, that's been one that I've been bullish on for months, and it's, performing amazingly. So you can see here, it's got, pretty much highest possible composite rating, highest possible EPS, highest possible, or close to RS rating, #1 on the overball leaderboard. And you look at the performance over the last few months. So, that's another way that I find ideas as well. I'm not sure what the costs are exactly, but well worth it in my opinion. So, then I'll get those tickers and then I'll drill into them. And HZO I was bullish on from back in sort of January, December. It starts to get back above all these moving averages. If we go back 6 months, maybe 9 months, back in here, it's had this nice little pullback in an uptrend. The 200 days moving up, and then around here gets back above that 50, comes back and successfully retests the 50. That's a great entry point right there. Same here, it's pulled back and it's tagged that 50 and held a support. You can see it every time it just comes and does it. And you see here through the last couple of months, really nice accumulation. Like, I've actually really known very little about the company, but technically was great. And then here was like a prior high. Once it starts to break out above there, comes back, successfully retests that breakout. It's been just a great stock over the last couple of months. Yeah, good question, KC. So question is, would I consider opening a single leg option and then adding a second leg to create the credit spread later? So yeah, possibly. I don't love doing that, but yeah, you could say, you do a cash secured or a naked put on HZO, whatever at say 55 or 50 if you're aggressive. You sell that one and then hopefully the stock rallies up and then you buy the 45 later as protection. You can do that for sure. I don't do it a huge amount, but yeah, you can do that for sure. If you're pretty good at picking direction, there's no reason why you can't be a bit more aggressive and do stuff like that for sure. So in terms of account size, so look, I typically say about 20,000 is a good starting account size, but you can certainly start with 10 and get a feel for things. And it's never too early to learn, right? Your account might be 10 now, but hopefully over the coming years you'll be able to grow that through performance and adding more capital into it. So the strategies you learn now will benefit you for a lifetime, right? But sort of 20,000, 10,000 kind of absolute minimum for any of these trades. And if you refer back to that position sizing guide, we're looking at each trade here, about 900 risk. Where's our thing? So 900 at risk over 20,000. That's right sort of at the maximum, right? At right around 5%. If you refer back to the position sizing guide here, these green zone is kind of good. The orange zone is okay, but not so good. Again, you've got a small account at 5,000. A 1% trade size is almost barely worth it. You're only generating $50 in premium. Most of that's going to get eaten up in commissions. So anywhere in this sort of green zone is good. Again, 5% on a $20,000 account is fine, but you're just taking on a little bit more risk, right? Not sure if you're below 25,000 and you're restricted to 4 trades a week. I'm not sure. Don't know anything about that, but maybe that's broker specific, possibly. Yeah, Pratesh, I think it is. I can't read the full name, but yeah, if you want to get longer stock, you can do a cash secured put, but you then to reduce the margin requirements, you can do a spread for sure. I haven't got an example, but let's say you want to buy Apple and you do it via selling a put and hoping you get assigned. You could maybe sell quite close to the money. So you sell that put, hoping it either expires worthless and you keep the $400 odd, or if it drops below 120, you get assigned and you buy the 100 shares. Now, what we're saying here is if you do get assigned on 100 shares at 120, you need $12,000 to make that trade, right? And that might be prohibitive for some people, right? And if we turn it into a spread, buying that one, now we've reduced our capital requirement down to about $300. Yes, we might still get a sign and we still have to have that 1,200 or 12,000, sorry, if we want to take ownership of the 100 shares, but we've massively reduced our margin requirement. Now, it depends how you're set up within your broker. Sometimes you'll have to have the whole $112,000 to put on a cash secured put like this. Sometimes it'll be slightly less because the broker's pretty confident Apple's not going to go to zero. But if you do get assigned, then obviously, yeah, you're going to have at least that 12,000. So that sort of trade is definitely for people who've got bigger accounts. Yeah, there you go. So that's more day trading for that pattern day trader rule, 4 a day rather than 4 a week. So yeah, you'd obviously be pretty active if you're doing 4 trades a day. I wouldn't think many people would be doing that. KC, would a split capital across debit spread and credit spread, or does it not make any difference? Yeah, I might do a mix of both. I mean, typically I'm more doing the credit spreads. And as we saw earlier, whether you do a credit spread using puts or a debit spread using calls, it's basically the same thing, right? The only time I'd use a debit spread, is if I was really, really bullish and I'd be out of the money. So yeah, I might do some of that on stocks that I'm really bullish on. But yeah, mostly credit spreads, and then as we get going, we'll look at condors and calendars and butterflies as well. It's kind of the main ones, and diagonals. So we'll look at a strategy called a poor man's covered call, which is it's probably one of my favorite strategies in terms of stocks that I'm bullish on. Yeah, 1 to 2 months out is really good. Typically want to be sort of minimum 25 to 30 days at a minimum. And then it gets tricky when you're kind of in that intra-month period where it's say 15 days to the front month and 45 days to the back month. I'd tend to trade the back month. So yeah, once we get down under about 3 weeks, I'm going to then move to the next expiration. But like I said, I'll even do longer term trades. Like I've got quite a few trades on for January next year, and they move really, really slowly. They just kind of sit there and just hopefully slowly decay away. Yep, no worries, Perry. Happy to answer questions. There's been some great questions. I think this is going to be a really good group. Really excited. Try and get some conversations going in Discord as well in the chat room, and help each other out. Post some ideas in there. You'll get feedback from others as well as myself. All right, I'll leave it there. I'll get the replay out to everyone, and look for some emails from me in the coming days. Awesome. Talk to you soon, everyone. Thanks again. Take care. Talk to you soon.